In today's episode, we're answering some questions from the listener mailbag. And boy, we received some great questions that we all can learn from. Questions about taxes on inherited real estate, about Roth conversions, and then saving for retirement with irregular income. And we're going to kick off the episode with an article about the 7 most affordable states to retire in. And we talk about how taxes played a key factor in determining the top 7.
Welcome to the Your Life, Your Money podcast with Scott Sierens, teaching you how to thrive in life, wealth, and retirement.
Welcome back to the Retirement Show, all about your life and your money to help you thrive in wealth and retirement. I'm your host, Scott Sierens, and today we've got some listener questions. Hopefully a good way to learn together, learn from others. You might find yourselves in some similar situations. So a lot of good tips that you can take away from today's podcast. We've got questions about making 401k contributions on irregular income, Roth conversions, and then taxes associated with selling real estate. And one thing that you've probably found and that we're going to continue to do is bring good tax planning advice, tax strategies, and tax talk to you in each one of our shows, finding it a way to relate it to you and your taxes. Why is that? Well, there's a lot of things in life that we can't control, like the market and what it's going to do today or tomorrow. But there are some things that we can control, and that's taxes. And the more that we can work on controlling our taxes, the more that we can keep our hard-earned dollars, retirement savings, money that we've earned, keep it with us and in our pocket versus giving it to the IRS. And speaking of taxes, if you haven't yet, go to lifemoneyshow.com/taxes. Again, lifemoneyshow.com/taxes to download the tax strategy guide. What it is it's a guide specific to helping you save on taxes. What it does is it's going to walk you through strategies that you can utilize in your personal situation. And overall, what this means is that you can keep more of your hard-earned money with you to build wealth, to spend on other items versus giving it to the IRS. So again, if you haven't yet, lifemoneyshow.com/taxes to get your copy of the guide. Okay, before we dive into the listener questions, I have a great article that I wanted to share with you, again, around taxes as well. It incorporates taxes, but the article is the 7 most affordable U.S. states to retire. And then it says, and none of them are Florida. Here we go. So in this CNBC article, they're listing out the 7 most affordable U.S. states to retire. Now, this is based on a lot of different factors, and I'm going to link to the article in the show notes. You can go to lifemoneyshow.com. Again, that's lifemoneyshow.com. We'll have a link to the CNBC article there if you want to see the 7 most affordable states. The rankings were based on crime, weather, culture and diversity, health and wellness, and then at the end there, affordability. And that's the one key thing that I want to make sure is if you are looking to move, I want you to make sure that that is a key part of your decisions when you're looking to move. But let's talk about the top 7. Here we go, counting down from 7 down to number 1. Number 7, Georgia. 6, Oklahoma. 5, Kentucky. I have had a few clients move there. 4, Mississippi. 3, Missouri. Number 2, Tennessee. Seems like that is a hot state to move to. I'm guessing real estate values continue to grow up and up and up there. And then number 1 on their list, the 7 most affordable U.S. states to retire in. Number 1 was Michigan. And what was the key factor? Of course, weather, culture, diversity, health, wellness. But the one that I want to talk about here on our show today is the affordability. And what does affordability come down to? Well, one, just the cost of living in those areas. But the other thing that it revolves around is taxes. 2 types of taxes that you need to think about here. First, property tax. Now, I live in Illinois. We are a very high property taxed state. Some states have lower property taxes than others. So property tax is something that you want to look at if you're considering moving. Where you're going, what is the property tax versus where you're at today. And then the second part is taxes on your retirement income. If you're moving into that next stage of life where you're going to be making withdrawals from your retirement portfolios, like your 401ks, IRAs, 403bs, or if you are getting a pension, then you want to understand how that is going to be taxed. Now, those are all taxed from a federal level. We've got the federal level, but then also, what about from a state level? Is that state going to tax your retirement income? Are they going to tax that withdrawal that you made from your 401k or from your IRA? If you're getting a pension, are they going to tax your pension at the state level? And it's really important that you do your due diligence. Couple examples here, a few stories. I had a few clients that living in Illinois, they couldn't wait to get out of Illinois, but then they moved to a state where, yes, their property taxes went down. However, the states that they moved to were now taxing their pensions, were now taxing the withdrawals from their IRAs. And so as they were excited to move out of one state, hoping for cost savings, it actually, as we've kind of gone through now a couple years, they've looked at it as a wash. And, part of the reasons for them moving wasn't necessarily the high property taxes of Illinois. They had family that they wanted to get closer to. So the fact that it was a wash was okay for them. They're now closer to their family. I've had a few clients that wanted to just, move to a different state because they were looking for the cost or the tax savings, in which case they moved to a state in which their property taxes went down, but we had done due diligence in advance, and the state did not tax their pensions as well as does not tax the retirement income, just like they weren't getting taxed in the state of Illinois on those items. So for that couple, moving to another state was actually a tax savings for them. The other thing is to be aware of, just the cost of living in that state. They said Florida did not make the top 7 because the cost of goods and services and just overall affordability, they say, continues to skyrocket in Florida. And so that's why they did not put it on the 7 most affordable U.S. states to retire. However, I do know it's a great place that people love to go to because of the weather in the winter and the taxes on retirement income, or I'll say lack of. They don't tax your retirement income down in Florida. So could be a good state to go to depending on what you're looking for. So as always, do your due diligence up front. Talk to people in the area about crime, culture, diversity, health, wellness, and then we talk to our clients all the time. Something that you want to look at and understand is what could be your tax situation if you were to move to a different state. Very important to understand those facts. So if you're looking at moving, hopefully this put a few other pieces of information in your mind, so that way you're not moving to a state in which at the end of the day you're going to have less income coming in. Retirement's a time for income, enjoying what you've worked so hard to save up, and we want to make sure that you're maximizing your retirement as well as your income and minimizing your overall taxes. With that, let's dive into our listener questions. Our first question of the day comes from Carrie. Carrie writes in and he says, I just started a new job that has higher upside than my previous job, but a lower base salary. I'm counting on some big commissions in my future, but my base salary is low enough that it would be hard to contribute to a 401k and still pay my bills. Is it okay to just use my commissions for retirement savings, even though those payments will be somewhat irregular? So basically, hey, first off, Carrie, congrats to you on your new job. And with the higher upside potential, that's great. And I think what Carrie's saying here is that his income, while it's overall at the end of the year when he tallies it all up, is going to be higher, it's going to be a roller coaster, an up and down of some little base salary, some commissions that come in sporadically throughout the year. And those ups and downs will add up to a higher salary at the end of the year, but it will be a roller coaster throughout the year. Carrie, before I dive into some thoughts around your question here, I have a question for you. Have you ever had a project that you were going to start and you said, I'm going to start this as soon as I have time? And then years go by and the project never started. This has happened to me before. I'm guessing maybe some others, right? And this is one thing, Carrie, that I just don't want you to get caught up in when it comes to your retirement savings. And it sounds like the fact that you're already thinking about this, that it's on your mind to make sure that you're saving for retirement. But let me first help with maybe a little bit of a mindset shift. And what that would be is it sounds like you're in a totally different job here where your income is going to be irregular. Now, based on that, one of the things I'd really recommend is building up more of a buffer in your savings account, or if you want to call it your reserve or your rainy day fund, but build up more of a buffer there. So if you only had 3 months, go to 6 months, or I would even say go all the way up to 9 months to a year. Trust me, you'll never feel bad for having cash on hand to pay for things because as you go through this irregular income. So first I would say building up more of a cash reserve in your savings account because irregular income can be really tough, and having that buffer, right, will help you not feel like you're living paycheck to paycheck to commission check to paycheck. Having that buffer, you'll just have a nice little savings account there. Go and grab from, live your current lifestyle and pay for your expenses and your bills as you do, and it won't feel like stress at the end of the day. After building up that nice buffer in your savings account, the next thing that I would suggest to do is I would suggest that we still save something from that base pay. Even if it's just getting to the company match, I would still suggest. Now, remember, you're thinking, you already told me, well, wait a second, I don't have enough in my base pay to pay my bills. With the buffer intact, we've got enough there, right, for the fluctuations to get you between, from commission check to commission check, to get you from those peaks of the roller coasters when the commission checks come in, from peak to peak. We've got, while you're going down that trough, we've got that buffer there to live off of. So with that buffer there, now you're able to go and up the contributions from your base salary. And the reason I say to do this is because that commissions are never guaranteed. And I don't want years to go by and you're like, oh, I never got started on that retirement savings. Because all too often when we say I'll do it later, it never happens. So if you can, push yourself to at least get the company match coming out of your base salary. So if they match, 100% up to 3%, or based on putting in 6% or 4% or whatever the number is, I would try to at least get that company match amount coming out of your base salary. The other thing is to make sure as you automate this, when your commission does come, make sure that your company knows to make a larger deduction from your commission. So if each and every year you were trying to put in $15,000 or $20,000 or, the current max of upper $20,000 if you're over age 50, make sure that, if you're only putting in, let's say 3% to get the company match on your base salary, well, when it comes to your commission check, you might need to up that. So don't forget, before that company commission check comes, talk to your company. You might need to up the percentage, take out a higher amount on your commission check to still hit your end goal of how much you wanted to save for the year. So figure it out in dollar terms, because sometimes percentages won't always get you there. And by doing that, hopefully it still keeps you on track for retirement. So just to recap, talked about a lot of things here. First part is building up your buffer. Second part is getting at least the company match out of your base salary, leading to the third part, which is paying attention to your commissions. And as they come in, you might need to increase the percentage or dollar amount that's coming out, going into your retirement savings to hit your end goal that's going into your 401k. But as a reminder, Carrie, be careful. Commissions are never guaranteed. And, if we keep saying, hey, I'll save as soon as I get a commission check, and I'm sure that you're going to do great in this new job, we just don't want years to go by and nothing gets saved or not enough gets saved. So, Carrie, hopefully that helps you with your question on irregular income, saving into your 401k. Thank you so much for sending it in. Our next question here comes from Harold. Harold says, I'm almost 60 and don't have any money in Roth IRAs. Should I be converting some IRA money to Roth for the next few years? Well, Harold, there's a lot actually going on in your question here. And let me break it down to help others that are listening as well, because we get a lot of questions on Roth conversions, and we actually do and help our clients with a lot of Roth conversions as well. Now, I'm going to say before this question, and actually for all these questions, make sure that you sit down with and talk to your financial and tax professionals before implementing any strategies. These thoughts and strategies and ideas that I'm talking about today are guidance, but they're not specific to you. And so make sure you sit down again with your tax and financial professionals to get specific guidance to you, but hopefully we're helping you with the questions to ask and the direction to head down. And if you don't have one, feel free to reach out to us, lifemoneyshow.com. Again, lifemoneyshow.com. Click on the Work With Us tab, and we'd be happy to have a 15-minute phone call and see if there's a potential fit of working together. Okay, so let's go back to Harold's question. All of his money is in IRAs. He's wondering, should I be converting some to Roth money? Well, first, as I mentioned, there's a lot going on in this question. One part is that all of his money is in IRAs, and you could replace IRA with 401k or 403b or 457. So if you have all of your money in IRA, 401k, 403b, this relates to you. The next part that he brought up was, should we be converting some money? We'll talk about that. And then the timing, and there's a couple parts of that. One based on current tax laws expiring, and then market timing of doing the conversion. So let's start with all of your money being in IRAs, 401ks, 403bs. Having the money in IRAs, 401ks, all of that money that's in those types of accounts, those tax-deferred accounts, none of that money has been taxed yet. So if you have $1 million in your IRA or 401k, do you actually own $1 million? And the answer is no, because you own $1 million less what you owe the government, the IRS, for taxes. The other thing to be aware of in these accounts is that at age 72, you're going to have to start taking forced income. That's your required minimum distributions, but that is forced taxable income. So first part of Harold's question here, he's got all of his money sitting in an account that has yet to be taxed, and at age 72, 12 years away, he's going to have to be starting to take forced taxable income. So he brings up, hey, well then should I move this money, called it a conversion, move this money from the IRA to the Roth IRA? Now, when you move from an IRA to a Roth IRA, what you do is you're paying tax on the money today to move it into the Roth IRA, which is a tax-free bucket. Sounds like a pretty good idea, right? Moving from where it's at today, where it's going to get all taxed in the future, you pay the tax today, move it into that tax-free bucket. Once it's in the Roth IRA, it grows tax-free. So if you put $200,000 in and it grows to $500,000, all $500,000, the $200,000 that you put in plus the $300,000 of growth, you can withdraw all of that tax-free in the future. So that's the conversion part. Now, why would we want to do that? There's the timing part. Should I be converting some IRA to Roth? And Harold says for the next few years. And why is he saying for the next few years here? Harold, thank you. I'm just, again, still utilizing your question here to help everybody out. One of the points why he's saying it would be maybe a good idea over the next few years is because of the Tax Cuts and Jobs Act. That is the act that was passed that lowered tax rates basically across the board for everybody, but it's scheduled to expire in 2025, in which case, if Congress lets it expire, everyone's tax rates based on the amount of income that you have coming in most likely will go up. The other part to understand right now is that the market is down from a timing perspective. So why could it be a good time to do a Roth conversion when the market's down? I want you to imagine a spring in your hand. And right now that spring is compressed. And so you're thinking, boy, why would I want to take money out of my account when the market's down? Well, as long as you're taking the money out of the account while the spring's compressed, and let's call the spring your investments, right? The investments are compressed, but you're taking that compressed spring, you're still leaving it as a spring, you're still leaving that money invested, you're just putting it in a different tax account. You're just taking that spring now and you're taking it from your IRA and you're putting it into the Roth. Well, when you put that spring into your Roth and you let go of your hands, what happens? It comes back, it bounces back. History has shown us that the market continues to bounce back. So going back now, you're taking the spring, it's a compressed spring, you're taking it out of the IRA bucket, meaning, yes, you have to pay taxes on it, but maybe you're now paying taxes on a lower amount because it's depressed, it's a compressed spring, it's coming out of the IRA bucket, you're paying tax on a lower amount, you're getting it into the tax-free bucket, whereas you let go of that spring and it bounces back, it's now bouncing back with tax-free growth. That's why a lot of times we look at doing Roth conversions in a compressed, right, or depressed or lower market when the market's down, because it's good getting that money into the Roth bucket, allowing it to grow back up tax-free. Now, and I guess getting to Harold's question, sorry Harold, took me a little while to get there, but be converting some IRA money to Roth, let me tell you, there can be benefit at any amount saved in an IRA. However, I found that a lot of benefit comes for those that have saved $750,000 or more in their IRAs, 401ks, 403bs. But overall, as I had mentioned before, you need to really sit down with a financial professional, tax professional, or if you're able to do this on your own, you want to do a tax projection. And here's why, and Harold, should you be doing or converting some money, it's all going to be based on this tax projection, because that tax projection is going to look at your accounts, it's going to project some future growth for those accounts, and it's going to look at how much forced taxable income will you have starting at age 72, and what's that going to look like through the rest of your life. And I've found a lot of times working with folks that have saved up $1 million or $2 million or $3 million, that what they don't recognize is having those multiple millions in their IRAs and 401k accounts. Next thing you know, that can put you at a higher taxable income in your 70s, 80s, and 90s than where you might be at today. And if that's the case, if it's going to put you at a higher taxable income in your future than where you're at today, then you may want to consider those Roth conversions. The other reason that you might want to consider it, even if your taxable income might stay level through those years, is because of the Tax Cuts and Jobs Act expiring. Let's just say, for instance, you're in the current 12% tax bracket. Well, when that expires, the new bracket, if it goes back to the old levels, is going to once again become 15%. So if you know you're in the 12% tax bracket, paying tax today, you're paying 12% versus paying 15% after 2025. Now, we take a very strategic approach at this when working with clients. We're not just saying, oh, we got all this IRA money, we need to go convert it all to Roth IRA. We take a strategic approach, staying within certain tax brackets, just filling up some tax buckets, but not spilling over into new tax buckets. The other thing, Harold, I want you to be really careful on, because you said I'm almost 60. So I don't know if you're 59, 58, 57. For anybody listening that is 59 and a half and younger, be very, very careful on doing Roth conversions. Here's why. Is because taking money out of an IRA prior to age 59 and a half, you would have to pay the 10% early withdrawal penalty. Now, the good news is you can convert money from an IRA to a Roth IRA prior to age 59 and a half. Make certain that you have the cash outside of the IRA dollars to actually pay those taxes. You see, because a lot of times what people also will do is they'll convert from an IRA to a Roth IRA, and as they do that conversion, they say, you know what, I might not have enough cash on hand right now, so just withhold the taxes from the conversion. Well, the government considers you withholding those taxes. They'd consider, again, prior to age 59 and a half, that is income coming out, not staying within the qualified buckets. It's income coming out. And so you'd actually have the 10% penalty on that money that you withheld for taxes. So prior to age 59 and a half, be really careful. If you're going to do a conversion, make sure that you got enough cash on hand to do so that you don't incur the 10% penalty. After 59 and a half, I still recommend doing conversions and paying the tax with cash that you have on hand or cash from a brokerage account or some other account. It just puts more into that Roth bucket to be able to grow from you. But if you don't, we have worked with clients too, where what we've done is withheld the taxes on the actual conversion. But again, making sure that they're age 59 and a half older on that. Great question on Roth conversions. I know that this will be a topic throughout the end of 2022. A lot of these, actually, Roth conversions have to be completed by December 31st to make sure that it gets counted towards your 2022 taxable income. And so I know we'll be talking about a lot about Roth conversions throughout the end of the year here for year-end tax planning and tax strategies. Harold, thanks for sending in the great question. Hopefully you didn't mind me taking the time to just break it down, and I hope that provided a lot of guidance and thoughts for others that are looking at and considering Roth conversions as well. And our last question comes from Ross. Ross's question is, my mom died 2 years ago, and my 3 sisters and I inherited her house. I've always wanted to sell it. They're just now coming around to the idea, but now they're worried about the tax implications of selling it. I keep telling them that I don't think it will really hurt us from a tax perspective, but I can't really explain why. So can you help? Ross, sorry to hear about the passing of your mother. And good question on taxes and real estate here to be able to help you and guide others. Well, the answer is that you may or may not have some tax, but it wouldn't be on the full amount. If you were to sell the house now, the tax wouldn't be on the full amount of the sale. But you see, Ross, we have had a lot of appreciation or the value of homes going up over the last 18 months in real estate. And so you could potentially have some tax since you've didn't sell it right away. You've held on to it for 2 years since your mom passed away. You could potentially have some tax here, and let me just explain it. But one thing that you did receive when your mom passed away is what they call a step up in cost basis. So I just want to walk through an example here to help you and others understand the step up in cost basis and what you might potentially owe from a tax standpoint. Okay, here we go. Let's just say that when your mom, first off, let's start here. Let's say that your mom purchased the home for $300,000. That would have been her original basis, her original purchase price, the original value of the home. Let's say when your mom maybe she lived there for a while. When she passed away 2 years ago, the value of the home was now $500,000. When your mother passed away, that actually became the new basis for the home. So your basis is not the $300,000 that she paid for it. It's actually the step up in basis. So when your mother passed away and when you and your sisters inherited this home, you got the step up in the basis, meaning you got the step up to $500,000. Now let's say 2 years after passing, the value of the home is $550,000. Based on that step up in basis, you do have gains in the home that if selling it, that you would owe tax on. But the gains are not $550,000 minus the $300,000 that your mother paid for it. Remember, you got that step up in basis when your mother passed away. So the gains are the $550,000. Let's say now we're selling it for $550,000. The gains are the $550,000 minus the $500,000, the value, that step up in basis that you received when your mother passed away. So you're really looking at $50,000 in gains that you would potentially get taxed on. Again, this is a hypothetical example. This is something that you want to sit down with your financial professional as well as your tax professional to fully understand what you may or may not owe in taxes, but you could potentially have some taxes. Now, just because I'm saying, $50,000 in gains, you would be looking at potentially looking at long-term capital gains rate. So not all of that money is going to the IRS. You're just a percentage of that money based on each of your own taxable situations. A percentage of that money might be going to the IRS in the form of taxes. So don't worry, majority of the home sale and the value will stay in your pockets, but there would be a potential of some that would go to the IRS in taxes. Great question there. Real estate can be very tricky when it comes to taxes, and I'm glad that you sent that question in because you really need to pay attention to when you bought, when you sold, what happened, did you get the value of the home when your mother passed away, all to put yourself in that best position possible to keep more of that home value with you versus giving it to the IRS in taxes. So thanks for sending in that question. It was a great question. Hopefully that helped others out as well. A lot of great questions today around taxes. Thanks for sending them in. First off, if you have questions that you want us to answer on the podcast, go to lifemoneyshow.com. Click on any episode. Again, lifemoneyshow.com. Click on any episode. You'll see an area there where you can submit your questions to us, and we'd be happy to answer them on the show. Again, if you haven't yet, download the Tax Strategy Guide. As you can see, each question today revolved around taxes, and depending on how you structure yourself, how you structure your savings, how you structure your real estate, can potentially save you in tax dollars. We are a very tax-centric firm, taking tax planning approaches with our clients. And so you want to take a look at our guide that we've got out there, the Tax Strategy Guide. It's at lifemoneyshow.com/taxes. Again, lifemoneyshow.com/taxes. It's a guide to help you save on taxes. It's going to walk you through strategies that you can utilize in your personal situation, helping you keep more of your money with you versus giving it to the IRS, therefore building your wealth or giving you more to spend in the future. Thanks again for joining. I really look forward to our next conversation to continue to help you maximize your life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payment, the loss of certain tax reductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Please be sure to consult with a qualified tax advisor before making any decision regarding your IRA.